You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, let's start by looking at last week's trade, which is a very simple trade to look at. Why? Because it went in the direction that we wanted it to. We were looking at buying, after their earnings report, Nvidia in the money call option. So we went out to the July 16th date, and we looked at buying the 560 strike call. That was trading at $78. The stock at that point in time was at $628. And we actually even mentioned a fig leaf if you wanted to. We talked about maybe selling the nearer term 700 strike call, which actually would be expiring tomorrow. And that was trading on the bid at $1.30. So at this point in time, what was just kind of amazing about the Nvidia trade is that they had just announced earnings. Vol came off a little bit overall, but we were still able to sell if we wanted to and turn this into a fig leaf strategy. We were able to sell that 700 strike call for a $1.30 net credit to the account. Now, if you're going to buy Nvidia outright, and that's what we were really comparing this trade to, you're looking at that point in time, the market was exactly at $628, no change at all. So you're looking at $62,800 to buy 100 shares. So we went out and we reduced the risk and limited it to $78 or $7,800 of risk total by buying a deeper in the money call and going out to July 16th, which isn't that far out in time, but in the Nvidia world, that is a lot of time. So we got a high delta, about an 80 delta on that position. And right now, if we get a quote on Nvidia, and I should probably mention that we are taping Options Playbook Radio. It is a Thursday, and the markets are rocking and rolling. It is June 3rd. So the markets are open, and the Nvidia last traded at $672.21, and that's up $1 today. So if you did just buy the call outright as a paper trade, of course, and nothing's ever meant to be a recommendation, that option contract is obviously doing really well. But if you did the entire fig leaf where we're buying the July 16th call, selling the June 4th call, you're still doing fine too, because we're not even close to that strike at 700 yet. So at this point in time, you just let it ride. It's that simple when the strategy goes in your direction. And then you just decide, okay, when would I want to get out of my Nvidia call option? Where would be my price? And you can either base it off where the underlying stock is at, maybe by looking at the chart, see where there's, we just broke out and set an all-time high in Nvidia. So you can try to pick a way by looking at the chart technically, or you just decide when it gets to this level, I want to get out. That's simple. All right. So this week for Options Playbook Radio, we're just going to look at a rinse and repeat strategy that I've done time and time again. We've just gotten through earnings season, and we still have a few stragglers out there. But today we see the S&P 500 index is down 22 points right now. Last trade at $4,185.39. But more importantly to me, the VIX index has spiked a little bit. Now the new norm is below 20 as far as the VIX is concerned. And we currently see that the VIX is trading at 1823, or it's up 75 cents on the day. Now, I like the VIX around the 18 level to look at spreads in the S&P 500 index. So one of the things that's been nice about the VIX is that trading index options like the SPX are more interesting when we have the VIX up towards that 20 level as opposed to down towards the 10 level. You can do something with the option contracts. There's a little bit of juice in them. So one of the trades that I like to do time and time again, and as a matter of fact, you can even repeat this on a weekly basis if you wanted to, is to just, when the VIX is around the 20 level, we start the trade by getting into a time positive long spread. So let me explain how that works. So once again, we're taping Options Playbook Radio right now, and it is June 3rd. The markets are open. So with the stock or the index at 4,185, we're going to sell the 4,185 strike. We're going to go out 8 days to expiration. We need this to be a very quick trade. As a matter of fact, I prefer to do them on a Monday, but we're taping the show on a Thursday and just have 1 week for them to be trading. But overall, I still don't mind this trade because we got the spike up in the VIX today. So we're going to look at selling the 4,185 strike with 8 days to go. The June 11th expiration expires next Friday. And then we're going to buy the 4,180 strike call. It's only a 5-point wide spread, but we're selling the at-the-money option contract that has all the time premium in it. And then we're buying a little bit deeper in the money option contract. Now, that means that if the stock just stays where it's at or drifts higher, this trade is going to be good. We just needed to finish above 41.85 by next Friday. And in that situation, we're going to put this entire trade on for a net debit of $3 to the account. So we're risking $3 here. And then in this trade, the maximum upside would be the width of the spread, which is 5 points, minus the $3 that we paid for it, or $2 overall. All right. So we put this trade on today. We come in on Friday. We see, did the market go up or did the market go down? And if the market does go down, and we'll talk about this next week, well, then we're going to leg into a butterfly trade. And we're going to give ourselves a little bit of I don't want the cheese anymore. Just let me out of the trap. So when the VIX is elevated right now, and we're able to put on this long spread and get a decent risk reward. And by decent, I mean we're paying $3 to make $2. And the market can either stay where it's at or go higher. Even if it goes down $1 in theory, right? We're still up on the trade because that spread would be worth $4 then in that instance. And we put this entire trade on for $3 overall. So in general, it's a very straightforward trade. And when the VIX is trading around this 20% level, you can usually get it on for a decent risk reward. Now, Let's address different situations. If the VIX was trading down around 10%, it would be really hard to sell that at the money and get that same type of risk reward. You would have to end up paying more for it. And if the VIX was up around 30%, well, then you got a lot of volatility that you can deal with. Yes, it might be a little bit cheaper to sell that at the money option contract overall, but then volatility, then you're dealing with a crazy market. So when the SPX is trading around this level, this is an interesting trade to me. You put it on. If the market spikes up 20 points tomorrow, all right, let's just let it ride and see what happens. Market spikes down 20 points tomorrow, well, then we might adjust the trade, and we have that adjustment. Our adjustment's going to be that we're just going to roll into a butterfly trade and then just kind of play the hope game, hope that the underlying market starts coming back. And we'll look at this trade next week. Now, nothing's meant to be a recommendation here on Options Playbook Radio. So overall, it'd be kind of interesting if the market did go down by next week. And we were able to look at the adjustment on the trade, because you learn a lot more from doing trades that the market goes against you as opposed to where you're always correct on your forecast. All right. So I'll give you one last summary of what we're looking to do. Right now, we have the S&P 500 index down $22.73, trading at $4,185.39. We're going to go out to the June 11th expiration, and we're going to execute a long call spread. We're going to be buying the 4,180 strike call. We're going to be selling the 4,185 strike call, the most at the money call option. Right now, the midpoint on this long spread is $3. The maximum width of the spread is $5. So we're going to be paying $3, hoping to make $2, and we have an adjustment ready. We're going to make one adjustment before that Friday expiration if the market goes against us and goes down. And that's going to be it for this episode of Options Playbook Radio. If you have any questions that you would like to send me, my email address is theoptionsguy@invest.ally.com. Please follow me on Twitter. It's very easy. My handle is @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.